Hello, everyone, and thank you for joining today's webinar. Today's program will be presented by Jason Rosenberg, Jonathan Weinberg, and Zowdy Tang. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Jason.
Thank you, Jessica. And thank you, everybody, for joining us today. With the recent developments under PL 86272, today is a good time for everybody to get together and discuss some of the activity that we're seeing from a national level and a state level. So in 1959, President Eisenhower signed into law the Interstate Income Tax Act of 1959, which is more commonly known in the tax community as Public Law 86272. Due to a flurry of Supreme Court cases in the 1950s, the business community reacted quickly, calling upon Congress to put in place more clear-cut rules around establishing nexus in a state. The business community pointed to the compliance burdens faced by businesses that sold products into multiple states and the onus on businesses to comply with varying state tax definitions that were in place at the time across the nation. So as a result of this, at the time back in the 1950s, Congress enacted Public Law PL 86272, and it was originally designed as to be a stopgap to limit state tax power on remote sellers in the attempt to quickly respond to recent court case rulings. As we'll discuss more in detail today, the law under PL 86272 prohibits a state from imposing income tax on businesses that only sell tangible personal property, and its activities in a respective state do not exceed the solicitation of orders. Due to the ambiguity of the law, a lot of the key elements to the federal law over the years have been opined by the MTC through what we call a statement of information, attempting to address some of this uncertainty. The MTC issued its original guidance in 1986, and its most recent adoption, which we'll be talking in great detail today, in August of 2021. So, although the U.S. economy has dramatically changed over the past 60 years since inaction, the law was never amended to consider the typical business models that we see in this current digital age. So this 2021 revision adoption that we just saw recently in August, and we're going to talk in great detail today, updates the MTC's interpretation of 86272 with regard to business internet activities. As such, today we're not only going to look back at the history of 86272, but we're also going to talk about some of these recent developments and how this new MTC interpretation may impact businesses that are claiming 86272 protection. So with that, let's go to the next slide. And I will kick it off with introducing myself and then hand it off to our other presenters. So starting with me, I'm a senior manager. I'm Jason Rosenberg, a team leader of Witham's Salt Income Franchise Service Line, based in the New York metro region. I have experience in advising clients in multi-state income taxation, which includes state tax planning, nexus analysis, revenue sourcing, and audit defense across all industry lines. So now I'm going to hand it off to Jonathan to introduce himself, and then Zowdy to give a brief intro of himself as well.
Jonathan Weinberg is Senior Manager in the State and Local Tax Practice. I've been in state and local tax my entire career, primarily focused on income franchise issues, but also do some sales and use tax, as well as miscellaneous tax and individual income tax issues as well. Just overall, it's been exciting to see how 86272 has evolved over the course of my career, and it's going to be even more interesting to see where this goes in the future. Zowdy?
Hi everyone, my name is Zowdy Tang. I'm a manager in the State and Local Tax Group. I assist Jonathan and Jason with basically a variety of all the topics they've stated previously, so a little bit of everything. I think it'll be an exciting topic today, so without further ado, let's get started.
Thank you. And as we jump into the table of contents real briefly, As I discussed a moment ago, we're going to kick off today discussing, how we got to today, the history of 86272, because that's going to be incredibly important to any claim on federal protection. Then we'll walk through some of the events with the changing economy, recent court cases, but we'll touch, with Wayfair and how that might have influenced the recent revision to the MTC interpretation. And then we'll jump into some of the specific details of the most recent MTC guidance that was put out with this latest interpretation of the law. So without further ado, let's jump in, Jonathan.
All right, so let's get into the history. So being a history major back in college, this is something near and dear to my heart, because in order to know where you're going, you need to know where you've been. So again, as Jason previously alluded to, we have the interstate income tax of 1959, known colloquially as Public Law 86272, codified at 15 U.S.C. 381 to 384. It was enacted to legislatively overturn the Supreme Court's decision in Northwestern State Portland Cement. So in Northwestern, the Supreme Court held that Minnesota could tax an Iowa corporation that all they did was solicit sales from an office in Minnesota. And this is one of those cases that generated a lot of mail to Congress. A lot of people wrote their congressmen, wrote their senators, and so we wound up with Public Law 86272. And as a federal law, 86272 applies to every state, the same as every other federal law. So moving on to the next slide. So we're going to jump right into the polling question number 1. So who is the president who signed Public Law 86272 into law? Richard Tricky Dick Nixon, JFK, one of the ones between Madison and Truman, or I like Ike? We'll give it another few seconds here for people to put in their answers. And shall we go to the results? Okay, so yeah, no, not Richard Nixon. Most people, the plurality did get I like Ike, that he was the president that signed 86272 into law. So moving on to the next question, or next slide. So the text of Public Law 86272, we're not going to read the text of the law, but one of these things is putting the presentation together. I realized it had probably been well over 10 years since I actually sat down and read 86272 verbatim. So it covers 3 separate code sections within 15 U.S.C. Again, it's specific to net income taxes. It's specific to interstate commerce. So we can just kind of flip through the code sections here. It's in the slides for people to read if they choose to do so, or if they're having trouble sleeping tonight. This might be something to help you off with that. So again, we can go through, we'll pass 81C, again, dealing with solicitation of orders, dealing with definitions, dealing with representatives, who's protected, moving on. So right there. So this is a summary of the law. So this is where the rubber meets the road. So Public Law 86272 says the state may not impose a tax based off of net income when a taxpayer's sole connection to the state is a solicitation for sale of tangible personal property and the order is accepted and fulfilled from outside the state. So the way I say it is that 86272 is essentially the insanity defense to state income taxation. Because when you start asserting that you are protected under 86272, you're almost admitting that you have sufficient connections to the state nowadays for the state to impose a net income tax against you. But what you're also saying is that you have a really good excuse for it. So moving on, let's start getting into the history here. So again, historic limitations on 86272. Again, 86272 only applies to taxes based off of net income. So just because you're protected under 86272, you're not protected from minimum taxes. Again, you have an example of the Massachusetts 456 min tax. You're not protected from gross receipts-based taxes, such as the Texas margin, Washington B&O, Nevada Commerce. You're not protected from sales taxes, so you still have an obligation to collect and remit sales tax, even though you're protected under 86272. You're not protected from franchise taxes, such as the California franchise fee, the California LLC fee, and any other taxes not based off of net income, such as the New Hampshire business enterprise tax. So moving on.
Jonathan, real
Yeah.
quickly, so you mentioned, right, if a business is only selling tangible personal property, they might be able to claim 86272. What are your thoughts with a business that, let's say, they're selling tangible personal property across 50 states, but they also have a secondary revenue stream that is in conjunction or separate, but in conjunction with their primary sale of tangible goods, and they have like 1 or 2 customers, 3 customers with this service revenue, and it's only within 2 or 3 states? Do you think that it would tarnish protection across all 50 states as a result of having the service revenue? What do you think?
Right, and I think it's all very highly facts and circumstances specific. I think if they're soliciting the sale of the services nationally, that would probably end their 86272 protection nationally. Again, that 86272 only protects the solicitation activity. So once you start soliciting services everywhere, your 86272 protection ends everywhere. But again, like most things, facts and circumstances specific. So if a taxpayer can show that they limit their solicitation of services to a specific geography, for instance, maybe they have an assigned territory, they have a license and they can only solicit services in certain areas. Well, maybe it wouldn't end their 86272 protection everywhere, but it would certainly end it in the places where they are providing those services. So,
Yes.
So moving on.
So abroad, if there's a website, let's say, that suggests that they have a service offering, that could do a client in, that could do a business in, because that's not specifically geared to one region or one state or one customer. So, and we often see that where, there might be a secondary service revenue that is in addition to any tangible property, and oftentimes that could tarnish protection.
Oh yeah, absolutely. We're going to get into that, especially with bundled transactions and software-enabled products. So moving on to the next slide. So again, pass-through entities. A lot of states or a lot of businesses are operated as pass-through entities, so the business itself isn't paying the tax. The owners of the business pay the income tax. Well, the owners of pass-through entities are also protected from net income taxes based on 86272. So if you're a shareholder in an S corp, a partner in a partnership, a member of an LLC, if that entity is protected under 86272, you're protected from state income taxes under 86272. But again, claiming 86272 protection might prevent you from making a PTET election in the resident state. It might prevent you from making a PTET election in a non-resident state. And if it turns out that your 86272 claim was ineffective, most PTET elections have to be made by a certain time frame. So you can't go back and make the election after the fact when you're audited on your 86272 claim. So moving along. Okay, so we're going to look at the changing economy, and if you think about what did the world look like in 1959, it looked very different than it does today. I mean, I would argue that there's no one on this webinar that remembers a time in their career when Public Law 86272 did not exist. When 86272 was enacted, webinars did not exist. I'll even throw out there that when 86272 was enacted, there were probably only 48 stars on the U.S. flag because both Hawaii and Alaska were admitted to the Union in 1959. If you think about our vernacular, in 1959, any reference to the cloud was clearly a discussion about the weather. So moving to the next slide. What did America's economy look like in 1959? And this is what it looked like. So Zowdy, if you could play the clip. Unfortunately, the sound from the clip isn't coming through, but this is a rerun of I Love Lucy. It's in the public domain. That's how old this is. And this is really who 86272 was designed to protect, the door-to-door vacuum cleaner salesman. I have never seen a door-to-door vacuum cleaner salesman in my entire life, but in the 1950s, this was a very common way of soliciting sales because people didn't have televisions yet. Not everyone even had a radio yet. So if you wanted to market your products, you had to get that door-to-door salesman to take your product around to every single home and write up the sale. So moving on to the next slide. Okay, so when Public Law 86272 was initially enacted, purchasing goods, services, and intangibles were very separate transactions. That's no longer the case today. And today, a single purchase often includes a bundle of tangible goods, services, and intangibles. And just as a very brief, quick case study, we're going to quickly look at the evolution of John Deere, an iconic American brand. So next slide, please. Oh, sorry. We're going to go to polling question number 2. So please indicate my company lost its Public Law 86272 protection as a result of the evolving economy. Can still claim Public Law 86272 protection in some states. Still claims Public Law 86272 protection just about everywhere, or really needs to reevaluate where it can claim Public Law 86272. So we'll give everyone here a moment to vote. Let me just give it a few more seconds here and then we'll close the poll. And how about we go to the answers to see where the polling took us. So I think that's a clear winner where people are saying that they really need to reevaluate where they can claim Public Law 86272. So moving on. Okay, so this is the original John Deere from 1838, and just for reference, this is on display at the Smithsonian for anyone who comes down to the mall in DC. You can see this. This is one of the first John Deeres that were ever created, and this comes from an era when horsepower meant horsepower. It's clearly just a basic mechanical transaction, but this is a tool that revolutionized agriculture forevermore. Okay, so let's move on. Here we have the John Deere, the 1959 model, and someone would ride around on this thing in the rain and the snow and the heat and everything else from the hours of C to the hour of no C, and that's how farming was done. But we can move on to the next slide. This is very clearly just a mechanical contraction. Everything on that machine is absolutely mechanical. It's just rolling iron. There's no software. There's no intangibles. That's all it is. So, but you finally have an internal combustion engine at a price that farmers can use. So now we're moving on. We're going to move to the 1990 model. So at least whoever has to ride around this from the hours of C to no C, at least they're in an enclosed cab. Maybe it has AC or a CD player if they're lucky. But again, this is just a mechanical machine. There's nothing smart about it. There's no software in it. It's not intelligent. It's all human controlled. Okay, so let's jump forward now to the future. This is a 2021 model. It has all the bells and whistles. Moving on to the next slide. So while it looks like a tractor, in reality, the machine that you just saw is a very sophisticated software-enabled computer that rolls around in a field. Current John Deere tractors come bundled with the ability to increase horsepower on demand via software update that's remote. So a farmer, if they realize that they need more horsepower because their field is muddy, they call up John Deere, whip out their credit card. John Deere pushes a software patch to their machine wirelessly, and all of a sudden that tractor has an extra 100, 200 horsepower, whatever the farmer paid for it. Repairs, maintenance, upgrades, they can only be done by authorized service centers, because whenever they make a change or a repair or an update, they have to make changes to proprietary software updates, which also requires the payment of an additional fee. So again, when you buy a John Deere tractor now, a commercial John Deere tractor now, you're not just buying a machine. You're buying all that intelligent software and all the software updates that go along with it. And right there, the software is an intangible. So that's IMS 86272. Let's move on to the next slide. So let's get into historically protected activities. So, again, 86272 has been with us a long time. So there's a broad category of activities that are generally protected. So we have soliciting orders of tangible personal property versus via any sort of advertising, radio, television, newspaper. You can advertise however you like in a market, and that will not break 86272 protection. You can solicit orders via in-state resident employees or contractors, as long as they're not maintained in an office, other than a home office. Vacuum cleaner salesman, the missionary salesman who goes off and goes around on his rounds and is looking to write up sales. Providing samples and displays to individuals who solicit sales. That it only makes sense that your sales force can give away some samples, that they have display merchandise. Again, you can furnish and set up display racks. So if you sell to CVS, you can provide CVS with an end cap display so that they can market your goods most effectively and drive those sales. Moving right along. So you can provide automobiles to your salespeople to do their activities. You can coordinate shipment and delivery of goods, as long as you're not charging for it, because as soon as you charge for providing logistics services, now you're providing a service. So you have to give that away. You can also do things like do inventory checks to see when a customer needs to reorder. Do they have sufficient stock? Again, you can do recruiting, training, motivating, and evaluating your sales personnel in the state. You can have meetings for your sales personnel to get them pumped up in a state, and that doesn't break 86272 protection. Moving on. Okay, again, sales personnel can pass customer complaints on to the home office, but they can't resolve those complaints because resolving those complaints goes beyond solicitation. And your salespeople can only get involved in solicitation. But again, the law recognizes that the salesperson is probably the first point of contact for a customer who has an issue, and the salesperson can take that complaint and pass it on to the home office. And of course, you can maintain property in a state necessary for salespeople to do their job. So you can give your salespeople a cell phone. You can give them laptops and software and fax machines and whatever else they might need to do their job, as long as it's related to their selling function. Okay, moving right along. So for every activity that's protected, there's probably 10 activities that are unprotected. And we'll go through some of these right now. So, these are clear-cut activities where if your salespeople, employees, or independent contractors are doing them, this goes beyond solicitation and will break your 86272 protection, really without a doubt. So again, if your salespeople are dealing with collections on delinquent accounts, that is not solicitation. That's collection activity. That will end 86272. If your salespeople address customer complaints, that's not solicitation. Your salespeople investigate customer creditworthiness. Remember, a lot of your salespeople might be commission-based, and if the customers don't pay, or if they're deadbeats, the salesperson doesn't get paid. So if they start looking into the creditworthiness of who they're selling to, that'll end 86272. If a business repossesses property in the state, that will end 86272. Accepting orders on the spot. There are all kinds of issues with on-the-spot orders, but remember that 86272 requires for the order to be accepted and fulfilled from outside the state. So, if you have a salesperson that fulfills a sale outside of their samples, I've seen this. My father's actually a salesperson. He fulfilled an order for a customer. He sells cutting bits, and one of his customers was down to his last bit, and you never know how long they're going to last. So if that cutting bit broke, that assembly line would be shut down until they could get a new one. Well, my dad had 2 or 3 bits lying around in a sample case, and he sold them to the customer. Well, that's an 86272 ending activity, because now you're not fulfilling orders from outside the state. You're just fulfilling them right there on the spot. Also, having remote employees not engaged in selling, working in the state ends 86272. And, especially as a result of COVID, there are a whole host of mobile workforce issues, almost all of which go well beyond the scope of this presentation on 86272. But many companies have found their employees, especially their employees that can work remotely, people in legal, accounting, marketing, they've gone off and scattered to the wind. Well, when those people start working in states where you're claiming 86272 protection, that 86272 protection goes away. Moving on to the next slide. So again, we talked about, well, you can have meetings in a state to pump up your sales force and get your salespeople motivated. You can train them on how to make sales more effectively, train them on salesmanship. But as soon as you have meetings in a state that are unrelated to the sale of tangible personal property, that will end your 86272 protection. So, we have a quick example where company A, they bring all their salespeople together in state X for a meeting to educate them about widget 2.0, the new bonus structure, and get them all pumped up. Well, okay, that's great. That meeting is probably protected under 86272. But then they realize they really like this location so much, everyone has such a great time, they decide to have a corporate retreat for all their employees in state X. Well, okay, 86272 ended right there. But then they go even further and they say, oh, wow, the retreat was such a success, we'll have our board meetings there. Well, again, that's going to end your 86272 protection. And again, in a mobile era where people don't necessarily meet at the headquarters, people need to be flexible about where they meet and how they meet. And they're meeting remotely, they're joining in remotely. All those things can break 86272 protection.
Yeah. And Jonathan,
right along.
Jonathan, just a couple of thoughts. To your point, right? You have to remember that 86272 is federal law. Whether the states like it or not, they need to comply with it. And as a result, the states oftentimes have a very narrow view of its application because it's not state law, it's federal law that they're supposed to comply with. And so, any of these kind of issues or tarnishing activities that Jonathan went through, right? This is just an example of some of them. It only takes one of these activities, one little gray fact pattern, one little issue that a state auditor takes a look and hinges on the fact that the company's broken 86272 for the entire protection to no longer be in existence. So just kind of keep that in mind. I mean, I've always said that 86272 is good law, at least until the internet, until this latest revision with internet activities came into place. It is good law, but the states do have very, very narrow view of this law. And so you just really want, if you're going to claim it, you want to make sure that there isn't any fact pattern that would later become an issue under audit.
Yeah. And it's also important, I'll throw out there, that it's important to have a handle on what your employees are doing. I've seen a number of cases where a company didn't realize its employees were doing prohibited activities in a state, and had they known they were going to go do those things, they would have said, please don't do that. Just absolutely don't do that. But because salespeople aren't thinking about this, marketing people aren't thinking about this, these things happen, and once they happen, you're tainted. And eliminating that taint can be very difficult or impossible. So the companies that are going to claim 86272 or planning on claiming 86272, they really need to have a good handle on all their activities that are going on outside the corporate office.
Yeah,
and we can move on to the next slide.
To that point, you may have, we may be speaking with finance people or tax people at the company, at the business, and they say, you know, it's a salesperson, but you need to make sure that we can substantiate that. You know, the state may ask, you know, where's the job requisition? If there's a bullet point in the job responsibility that suggested that that employee's job included inventory control or inventory stocking or inventory monitoring, right? That just because that person does or does not do it, if the requisition of that job responsibility suggests that they are doing it, that could be problematic. Or, you know, what does the employee's performance reviews say, right? Do the performance reviews suggest that there are certain activities that the salesperson's engaged in that exceeds, you know, any of these protected activities? So, you know, it's also, you know, we got to look at how you're going to substantiate it. What does the documentation say, you know, if a state were to inquire at some point?
Right. Okay, let's move right along. Okay, so also maintaining property unrelated to sales in the state, again, traditionally breaks Public Law 806272. So again, just some examples: clinical trials and product testing. Obviously, you know, very important in the pharma space. And large pharma trials where the company owns the drug that's being given away while it's in testing and trials, that ends 86272. Employing contract manufacturers in the state, owning raw materials or goods in process in the state. And if we think about all of our supply chain issues and just-in-time ordering and where things are being stored, again, all these new concepts that didn't exist in 59, those activities now end 86272 protection. Again, consigned inventory. This is one that trips up companies left and right. If you have inventory in the state, you can't claim that you're fulfilling orders from outside the state. You're fulfilling orders from inside the state. And again, you might not even necessarily know where your inventory is. I mean, Amazon is famous for moving inventory around for where it makes sense for Amazon to have it for their own logistical purposes. So again, we have a quick example where Amazon moves company X's marketplace inventory in a state Y in order to make Amazon's distribution of excess products more efficient. Well, Amazon just broke 86272 for company X in state Y by doing that. Because it is X's inventory, and now they are maintaining inventory in the state, even though they didn't tell Amazon to do that. In fact, if they had a choice, they would have probably told Amazon, please don't do that. But they don't have a choice. So, and again, Amazon wants everyone to be paying tax everywhere because they figure, well, if they have to pay tax everywhere, then everyone else should too. So, you know, again, this is something to keep an eye on, and these are transactions that didn't exist when Eisenhower was in office. Moving right along. Again, making on-the-spot sales, trade shows, or other venues. You know, I see this all the time where you know that people make a sale at a trade show where it's on the spot and the order is approved and accepted right there. Again, ends 86272. We talked about salespeople fulfilling orders from their sample case or displays. Maintaining returnable containers or pallets. You know, one of my favorite projects in the past was I had a client that was a brewery and traditionally only sold their beer in bottles and cans. But when they switched over to kegs, the way the beer industry works is that the brewery is the owner of the kegs. So, you know, they would sell 500 kegs of beer into a state, and they own those 500 kegs. That ended their 86272 protection nationwide because all of a sudden they went from, you know, only selling beer into the state where it's fulfilled from outside the state to owning kegs in all 50 states. So again, opening an office or setting up a pop-up store in the state, you know, you think about all the pop-up sales that happen nowadays, that ends 86272. And again, you know, we work in fractional on-demand office space arrangements like WeWork. Those didn't exist in 1959. And again, using those sorts of services for non-sales functions likely breaks 86272 protection. Moving right along. So again, other business activities that go beyond mere solicitation, providing on-site warranty repairs, maintenance services, installation services, picking up returned merchandise. and performing stock checks not related to informing a customer of their need to reorder. So there's a famous case around 86272 where Tic Tac would send employees out to all these convenience stores to make sure that the Tic Tacs on display weren't past their sell-by date. And if they were past their sell-by date, the employee would make the C store throw those Tic Tacs out and order fresh Tic Tacs. Well, again, they said that's going beyond 86272 because you're not soliciting sales, you're checking freshness, and that's not a solicitation activity. So all these common activities can break 86272 protection. So moving right along, more activities. So again, providing training or certifications, other for training your sales force on the products that they're selling or how to be a better salesperson. So the example I'm using again is a VDA project that I had. So my company, they manufactured auto parts, but they would also send people around to provide training and certification to mechanics in all 50 states on how to install the parts. And upon successful completion of the course, those mechanics would be issued certificates indicating that they're qualified to do whatever the job was that they were trained to do. And mechanics would have a binder of all these certificates indicating they know how to do certain jobs. And the more certificates you have, the better mechanic job you can get. You know, auto shops, repair shops are more likely to hire you if you have more certificates and less certificates. And again, the reason why the company did this is in theory that the mechanics that they trained would choose that company's products over their competitors when they went to do a job. But doing this broke their 86272 protection in all 50 states. And I'll throw out that, you know, when you're dealing with these activities that are breaking 86272, it really doesn't matter if an employee does it or an independent contractor does it. If someone is doing this for you on your behalf, if someone's engaging in these activities on your behalf in the state, that taint is permanent. That will not go away. And 86272 at that point is over. Moving right along. So again, engaging in transactions that are not selling TPP. And this is where the world has changed. 86272 has stayed the same for 70 some years. The world has changed around it. So again, providing apps on a mobile device, selling downloadable software, media, books, movies, providing any sort of SaaS or really any transaction that ends in a service, that ends 86272. So if you're leasing, renting, or financing property, again, now you're no longer just merely selling TPP. If you're participating in the sharing economy, if you're selling franchises, if you're licensing intangibles, you're selling extended warranties. All these transactions that weren't so common or weren't even contemplated in 1959, all these transactions today are commonplace, and all of them will end 86272 protection. Moving right along. And that takes us to our next polling question. So the question is, which of the following activities break Public Law 86272 protection? We have 1, maintaining inventory in the state. 2, making on-the-spot sales to customers. 3, providing training services unrelated to training salespeople. Or 4, all of the above. So please select the best answer and we'll give everyone a moment or two to submit their responses. Maybe just another 10 seconds or so. And so let's close it down and see what the responses were. I like seeing this. I mean, this is about as good an answer as you can get. 96% got the right response. So I'll take a 96% right answer every single day. So moving on to the next slide. So again, over the years, more and more states have been adopting Finnegan, and that certainly has effects on Public Law 86272 as well. So let's move on to the next slide and jump right into some Finnegan and Joyce issues. So Finnegan and Public Law 86272, like I said, is a recipe for a nexus hangover. So in separate filing states, again, we have every entity stands on its own. So if you have protected activities in one entity and unprotected activities in another, well, one entity doesn't necessarily taint the other entity. In Joyce states, again, under the Joyce theory of apportionment, only entities with their own nexus in the state include their sales attributes in the sales factor numerator. So as such, only entities that exceed Public Law 86272 in the state get numerator representation when it comes to apportionment. Entities that are protected under Public Law 86272 would generally say they don't have nexus in the state, and therefore those entities don't get numerator representation in unitary states that use the Joyce theory. So again, here we have, every entity stands on its own, and the unprotected activities on one entity doesn't necessarily taint its affiliates. But more and more states have been moving away from the Joyce theory of apportionment to the Finnegan theory of apportionment. So in Finnegan states, if one entity has nexus in the state, everybody has nexus in the state. That means that if one member of a unitary, combined, consolidated group, whatever the terminology the state uses, if they exceed Public Law 86272 protection in the state, this taints all affiliated entities. So as soon as one entity can no longer claim 86272, no one can claim 86272 in the Finnegan state. So moving on to the next slide. So again, even under the Finnegan rule, even intercompany transactions may break Public Law 86272 protection. So, we see this all the time where, situation A, company A purchases all of its inventory from affiliate B, A then sells its inventory to markup. Okay, since A and B, all they're doing is selling tangible personal property, they're both likely protected under 86272. But now we have A and B, they change their arrangement. So now A is receiving a commission, which is, let's face it, a commission sales agent is receiving a fee for a service. B is really the one selling the inventory. So since A is now providing B a service and not engaged in the sale of tangible personal property, in a Finnegan state, neither A nor B are protected in the state under 86272. Because again, A can't claim it's selling tangible personal. Only B can do that. Since A is a service provider, that ends 86272 for everybody in a Finnegan state. And moving on to the next slide. And that takes us up to the MTC and the new restatement. With that, I will turn it over to my colleague and friend, Zadi Tang.
You're on mute, Zadi. Zadi, I don't think we can hear you.
Zadi, can you get off mute?
Testing.
Well,
there you go.
I don't know. Well, sorry about that. Let's talk about the MTC, Multi-State Tax Commission. Basically, this is a perfect opportunity and a reason why we're kind of bringing up PL 86272 at this time of the year. The Multi-State Tax Commission is basically an organization is striving towards accountant and I guess some clients' dream towards conformity and uniformity within the state. If we can ever get there. However, it's not always perfect, but some of the functions that they do is that they recommend uniform state tax laws. They encourage compliance and consistency in tax laws. And I kind of want to bring attention to the first two words of those functions is recommending and encouraging. As we discussed that MTC doesn't have any legal authority or administrative authority to implement these rules. So they mostly just kind of draft up kind of language that states can adopt. And if multiple states adopt it, it will have the same language across all of them. Some of the other activities that they do is training, as well as supporting states engaged in tax litigation and advocacy of state interests. Something that you can also find on their state website is that they also help with voluntary disclosure programs for multiple states, as well as a uniform sales and use tax resale certificate that you can find on their website. So again, they try their best to kind of come up with uniformity between the states. And I kind of want to go through the timeline, as we discussed before earlier. It's more visual representation. And really, the original adoption is in 1986. And you're going to see that there's two time periods that had major revisions to their statement, which is one in 93, 94. That's the first one. And you got the 2001. And now this 2021 revision is going to take into account of the biggest change between in the last 20 years, which I think we all know is going to be bringing us into the internet age because of all the online sales we have. And basically, this was adopted on August 4th, and the purpose was to address the changes that occurred in the past 2 decades to reflect the economy that we have now. And I want to go through, similar to what Jonathan did before, regarding protected activities. And you're going to see that it might not sound too bad when we read through this, but we'll see when we get to the unprotected activity of how that compares. So these protected activities include selling only tangible personal property, of course, via website now. It only allows customers to search, read the product description, select it for purchase, choose delivery options, and pay for the items. So it doesn't sound too bad for now. Another item is placing static frequently asked questions on a web page and placing cookies on their computers and devices, limited to reminding them that they have items on their shopping cart, storing the information so that they can avoid re-inputting information, and reminding them what product they considered in prior browsing sessions. So doesn't sound too bad until we talk about the unprotected activities. As Jason mentioned before, this is a federal law, and states have no reason why they don't want to make sure you break these rules so they can tax you. So these are the only type of activity you're allowed. So let's go through some unprotected activities. So one, providing post-sale assistance to customers via chat or email. So now I know there's plenty of websites that does this, that we go on a daily basis. Soliciting, receiving online application for branded credit cards. Next one is going to be a big one, right? Company's website invites individuals to apply for non-sales related job openings. I know Witham Shore definitely has a section that allows for that, and I'm sure many websites also has that available on their webpage. Number 4, placing cookies on the computer, right? This is protected in before, but if your cookies allows you to adjust production schedule, manage inventories, or develop new products, that breaks the protection. So again, even though cookies are allowed, it depends on the function that they serve. It might be an unprotected activity.
And Zaddy, before you continue, if you go back.
Sure.
Yeah, so it's number 1, right? Providing post-sale assistance to customers via electronic chat or email. What I find so interesting about this is that, you know, prior to this interpretation, you know, having a customer service like a 1-800 phone number, right, where that customers would call in, that would not tarnish protection. But apparently, according to the MTC, by instead of using a 1-800 telephone number for customer service, using electronic chat via a website would tarnish protection. So I find that very interesting, and it's just a way for the MTC and the states to narrow its view of protection for 86272. And the other thing is with number 3, with this solicitation of resumes, you know, if this is the only activity that a company is facing under this new interpretation, I mean, one way I guess to get around this might be just to use a third party, you know, like an Indeed or Monster.com, and potentially just offload it offshore to a third party to try and mitigate any risks. if this was a big gaping issue for a business. So you can see, Zowdy, if you want to continue, obviously a lot of these activities, though, all they're doing is watering down the protection of 86272.
Yeah, absolutely. We'll continue. So other kind of unprotected activities include business remotely fixing by transmitting codes and upgrades to your computer. If the business offers extended warranties on its website and contacts with in-state customers to stream videos or music. So these are a lot of things that on a daily basis, I see plenty of websites that offer multiples of these items 1 through 7 at minimum. So yeah.
Zowdy, what do you think with any business that sells hardware at this point, any technology hardware, that probably have remote fixes or upgrades being done? I would imagine that's going to impact any business that's selling hardware.
Yeah, absolutely. Especially a lot of companies are moving to, and I think Jonathan described it with John Deere, even with tractors, what they're really selling is the software on the tractor. I mean, they can remotely increase the horsepower on a machine, so they know they can make repeated revenue from it. So they definitely want to get more of these software involved with the hardware piece that they're selling nowadays. So absolutely.
Yeah. Zowdy, I'll just throw it out there that I'm doing work for a motorcycle company, and their motorcycles are software enabled. So if your bike isn't running right, you know, that it's a little wonky, you can call up the manufacturer and via software update, they can tune up your bike and get it humming like a kitten again. So yeah. More and more products are becoming smart. And as your products become smart, your ability to claim 86272 goes away until probably the only companies that can claim 86272 protection in the future are companies that manufacture things like fish hooks, because you know everything else will be a smart object. So moving right along.
You can't be selling that through Amazon where it's on consignment, or you still have issues as well, and you can't be, you know, have resumes on your website or customer service chat. So, you know, and again, we have to keep in mind, and I think Zowdy might mention as well, is that this latest adoption back in August, right, we would suspect that there's going to be taxpayers out there that are going to litigate this law. And how this gets litigated, you know, that's an open question. You know, is it at the state level? Does it eventually get to the federal level? Does Congress eventually act? Who knows? Doubtful that Congress acts, but who knows? But there will be a lot of taxpayer rebuttal to this because it basically is taking a federal law that's on the books out of existence. And so the question does remain, you know, is there a filing position to put a claim in, but yet understand that there might be some risk, and it will depend on if there's litigation that's successful or not successful with other businesses.
Yeah, absolutely. I was just gonna say, it's nowadays you can see pictures of people updating their grills and their locks and their light bulbs. It's kind of silly. But we have polling question number 4. So the question is, do you anticipate that your business will be able to claim PL 86272 if the MTC's restatement is broadly enacted by the states? We never claim PL 86272. We'll be unable to claim PL 86272 in the adopting states. We may have to start paying tax in a few more states, or we do not anticipate it will be affected by the restatement. Make sure you vote to get credit for CPE. I think we're on 70%, so we'll give it a few more seconds. Give it, and let's close it off. All right, so the most people picked C. We may have to start paying tax in a few more states. And that's correct, and we will be kind of discussing the considerations of this restatement and why that may be or may not be the case, right? So we're going to have to analyze the impact of this restatement. Some things you want to think about, and I think a lot of people, when they launch their website, have not looked at their website for a very long time of what's kind of description you're using on your website now, and will you need to update your website and the functions available on it if this restatement is enacted in the state. Are those website functions integral to the operations of your business? And if it is, it might be a challenge to kind of, with the restatement, to still get protected. You're gonna have to monitor this. I know a question did come through regarding if there's any state that have adopted these changes, and currently no states, I believe, have adopted the changes, but this is fairly new, came out in August, and wouldn't be surprised that once one adopts it, many other states might jump on the wagon. And it is going to be a rise in difficulty as we're going to have states that enact these, and we're going to have states that don't enact them, and you're going to have to keep track. And maybe some states are protected, maybe some states are not going forward. So it's going to be very challenging going forward just to keep track of it. Jason just spoke about this regarding the challenges to the interpretation. Again, the MTC doesn't have specific authorities to implement these, but the different states is going to enact the same language, so we might have an argument over what's protected and unprotected under this language. But maybe to protect yourself, maybe you model out the impact of what this might do. What is a worst case scenario if suddenly all of your activity is unprotected? Maybe you want to see how that looks now, just to kind of understand the impact. And will you be taxed on all your unprotected income at this point? You kind of have to understand that.
And Zowdy, as you mentioned, right, the statement's intended to serve as a general guidance to taxpayers and provide notice how the supporting states will apply the statute. So, a supporting state is a state that according to the MTC, right, that adopts or otherwise expressly indicates support for this revised MTC statement by either legislation, regulation, or other administrative action. And other states may just otherwise indicate support for sections of the statement. So it's really going to be all over the place. The bottom line is how states, if they're explicit about it or inexplicit, some automatically conform, some do need to take explicit action. And even if they do automatically conform, are they going to, under audit, actually enforce it? So, it's only a few months after this adoption. And so there's not a lot of chatter on specific states and which ones how they're going to view this, but it's likely that most of the states are going to enforce this, because you have to remember the states are members of the MTC, and I believe it was a unanimous vote that supported this adoption by the member states. So the states did support it under, on a vote as part of an organization, part of the MTC. So it's most likely that they are going to enforce it. The question is, will the taxpayers challenge, and what should we expect with those legal challenges? What I would suggest is one thing, right? First, when we think about 86272, you got to make sure that you first satisfy the requirements under the old interpretation. If you don't satisfy the requirements under the pre-2021 interpretation, you're never going to get there. So that's number one. Then number two, if you think it's the new interpretation that's going to result in a business failing 86272, then it's worth having a conversation saying, okay, we think based on our activities we can get there, but this, new interpretation, do we change our business model a little bit? Do we put in, some planning to try and mitigate any of the risks, or do we just put in a claim with the hope that there will be successful litigation in future years by other businesses, by other taxpayers on 86272? So first, you got to get there on the first interpretation. And then you kind of look at 2021, in my view, to see how this impacts you, and you model it out, as Zowdy said. I think very, very importantly, you model it out to see what the tax impacts are. So, Jonathan, do you have any last words before we close this out?
No, I mean, I think that really the last word is, it's not that 86272 has changed, it's the world has changed around it. And as the world changes and the economy changes, the ability to claim 86272 is shrinking by the minute. So to the extent that companies are still claiming 86272, it's important for them to constantly evaluate whether those claims are still valid.
Great. Well, thank you everyone for joining us today. If there's any other questions, feel free to reach out to us. You can see our contact information here. Do not hesitate. We know that a lot of these recent developments is very fast moving. And with that, hope everybody enjoys the rest of their day, and take care.